Hello, everyone. Welcome to Crypto Concierge. It's me, Anton, and Hiro, as usual, here for you. We skipped a couple of weeks, too many things outside of this little podcast, but here we are. We made time, right?
That's right.
It feels good to be back. I know you haven't done any homework, and I'm not going to push you this time, but we still have some interesting topics to talk about. I'm sure you
Yes.
were willingly or unwillingly made aware of general situation in markets, right? Because who
hmm
didn't these days? President Trump is playing with the tariffs, and the effects are all over the place. But I'm not gonna necessarily talk about tariffs. Are they good or bad? There's a lot of content about this. It's a controversial topic, and I believe that only time will tell if it was a good idea, if it was a bad idea. But we will talk more about general stuff, as I like to set a foundation. We're still in a foundation setting period of our podcast, I think. So I want to talk to you about prices, market caps, and bonds. Why these topics? Because again, as I said, they are foundational, and because what triggered this idea is the headlines on the newspapers, on the medias, like U.S. market lost 10 trillion. US lost 10 trillion, something like this, and I see people recording
hmm
videos like, oh my goodness, today we lost 2 trillion. I don't know. So where did this 2 trillion go and how did it happen? Do you know what I'm talking about? Do you understand this concept?
I've seen the news, but I want to hear what you have to say there.
All right. Well,
Yeah.
in order understand where the 2 trillion or 10 trillion went and why five of them came back yesterday, we need to understand the
Mm-hmm.
concept of market
Yes.
capitalization and the price. Do you know what's market capitalization? Okay. What's price? I guess everyone knows, but in the context of stocks, for example, because that's
Yep.
most of the viewers can relate somehow. So I
hmm
will show you a few charts, and I'll show you a few charts, and I'll right. So
Okay.
this is a
Oh.
SPX 500, right, or S&P index.
Mhm.
I think we already mentioned it before, but today I will be talking about some companies and using them as an example, explain what's the price and what's market cap. For example, um, Ford company, right? Everyone knows Ford company.
Mhm.
They make cars, and when we look at down here in the bottom right corner, you see $9.12. That is a
Yeah.
price per share, for one share of
Mhm.
this company, right? And when someone tells you Ford is at $9, what does it tell you? Does it tell you anything? Is it a good price to buy? Is it cheap? Is it expensive? Any thoughts you have on
You mean
that?
for me?
Yeah, for you, of course.
Yeah, no, I have no idea. No idea how
Or
to even read that price.
yeah, exactly. Or for example, if
hmm
someone tells you Amazon is $182, is it expensive? Why is Amazon 182 and Ford is 9, right?
Okay. Is there
Or
Walmart?
of course there's Walmart. Let's see. Walmart. Yeah, I even have it here, but I'll just it's $90. So Walmart is 90.
Mm.
Amazon is 182. Is there any does it mean? Does it mean it is
Mm.
twice as cheap as Amazon or not? Well, logically, I'm just saying,
Yeah. Yeah,
like
yeah,
I'm
yeah.
telling
Half
you,
price, yes.
there is
It's half
Amazon
price.
183 and Walmart is 90. What's the best buy? What would you like to buy? Is Walmart undervalued or Amazon is overvalued or right?
Couldn't tell. Couldn't tell.
Or rather, would you choose one Amazon and two Walmarts kind of thing? If you had $200 to spend, would you buy one Amazon and two Walmarts? No, because that's how usually people think of these things, right? When they just
Sure.
see the price,
Yeah.
they think that Wendy's at $12
hmm
is cheap,
Yep.
McDonald's at
Yep.
300 is expensive, for
Yep.
example.
Yep.
But this price for me meaningless, and it should be for
Mm.
anyone. It's literally doesn't mean anything. Why? Because you don't know how many shares exist. because you don't know how many shares of Amazon exist. Is there a million shares or a billion shares? And to understand better the price of a company in the whole, you need to this number. You need to understand how many shares are in total. And to do this, you can scroll down even here in TradingView, or you can Google this information. It's obviously public information. You can find a number which is called market capitalization, or MCAP, as we write it down short in a short way. So market
Mm,
capitalization of Amazon is
mm.
1.94 trillion, almost 2 trillion. What's this number represent? Or how did we get here? This is the price of one share multiplied by the number of shares, right? So if you take how many shares are in Amazon, which I don't know, but it's probably written somewhere here, but it's less important. The important fact is that this down to the number of market capitalization. So now you can look, for example, at McDonald's, which has a market capitalization of 200 billion, and Wendy's has a market capitalization of 2 billion, right? So the price of Wendy's, let's say, is $13, McDonald's 300. Looks like McDonald's is 30 times more expensive than Wendy's. But if you compare market capitalization, you know that McDonald's is 100 times bigger than Wendy's. So when comparing the prices of the companies, you need always think about market capitalization more than the share price. Does it make sense?
Well, I was going to say why.
Well, because for example, right now McDonald's is $300 a share. Market
Yep.
capitalization is what was it here? Market capitalization 216 billion. McDonald's can
Hmm.
do a share split. It's a very common practice. They can say tomorrow, instead of three, like for every one share you hold, you're gonna get 10. Now, what's gonna happen with the price of McDonald's is gonna go to 30, because you will, instead of one
Yep.
share, you will get, it's like a smaller denomination, but the market
Yes.
cap's not going to change
No.
just because they split it. So your
Yep.
price didn't drop 90%.
No. Neither
Yeah.
did our asset drop, right? Just having
Of
those
course,
things.
of course.
Right.
So you
Yep.
always have to look at the market capitalization to understand, at least to be able to compare the companies. I'm not saying the McDonald's is a better buy at 200 billion than a Wendy's is at 2, but at least we can compare apples to apples. Because when you just compare the price, it is impossible to compare. Because if McDonald's
Okay.
tomorrow
So,
says 1 to 100 split, McDonald's gonna be
mm.
$3 below the Wendy's, but the companies didn't do anything. It's just the numbers. Go ahead.
So what is the MCAP?
Is market capitalization, is the number of
What is that?
shares, is the price times the number of shares issued, comes market capitalization. So it's a total value of the company.
Okay. So it's the total value of the company.
Yes.
But why is it called market capitalization and not say it total value of the company?
Because it's not really total value of the company, I guess, because the value is not exactly the price, right? Like value can be
Sure.
appraised in a different way.
Of
But
course.
if you
Yeah.
if you're Elon Musk and you want to buy McDonald's for yourself, go ahead and say, okay, 216 billion is what's the market is pricing your company right now. I'm gonna give you 220 and buy all the shares, kind of thing, you know. But you cannot come with a
Right.
hundred billion, and they would be like, well, it's not enough.
Yeah.
So that's how he bought Twitter,
Right.
actually. So he looked at the
Right.
market capitalization and he actually paid a little bit of premium. So the
Hmm.
price went up. So the price and value is not really exactly the same, obviously, but
Okay.
that's just a way for you to think about these things, right? Now,
So so so
yeah, go ahead.
then is it fair to say instead of the actual share, um, is any corporate's goal to have more and more market capitalization number? Is that the goal?
Well, growth of market capitalization. Market capitalization is usually how the companies are compared one to in another. It's one of the metrics. You can compare assets, you can compare liabilities,
Mhm.
any other things. But market capitalization is the whole price of the company, not the value, but the price. So sure, in most, shareholders and managers and everyone would like the market capitalization to grow while the price, again, they can cut it. They can say 1 to 100 and the price would drop. So the price of the share is literally irrelevant.
Yes, and the market capitalization is also kind of irrelevant if you're not looking to sell. Is that correct?
Market capitalization is irrelevant if you're not
No,
looking to
basically,
sell.
to be in this game is saying you're willing to sell a part of your company, right?
Yeah.
Okay.
But also what I want to,
That's why regardless of the value of the company, certain companies do not enter this game.
yeah, sure.
Got it.
But
Hmm.
what is also important to realize
Mm,
and recognize another newbie mistake. One newbie mistake is just compare the price. Ford is
mm,
$9. Great
mm,
price. Why? Because
mm,
Tesla is 150. Well,
mm,
that's out. I hope that after this segment of the video, you understand that's the way to compare, right? If you want to compare them, go ahead and at least compare market capitalizations. Okay. Now, a headline from this week wiped off the stock market. Where did they go? They didn't go
mm,
anywhere, really, because 10 trillion were not there to begin with. Remember, market capitalization is a mathematical result of this equation, right? Price times the number of shares. If McDonald's price drops 10% today, because there will be some selling, right? The market capitalization will lose 10% of 217 billion, 21 billion. So McDonald's will lose 21 billion if the price drops 10%. But 21 billion, they haven't left the McDonald's. The effect of maybe sale of 1 billion or 2 billion can cause a 10% fluctuation if the price. But because market capitalization is simply the math,
mm.
looks like 20 billion disappeared, but it didn't
Sure.
disappear. It's not like someone
Mm.
cashed out 21 billion, right?
Got it.
It's not
Yes.
like
Yep.
that, right? Now,
Hmm.
how
Hmm.
much needs to be sold to push the price 10%? That's a different question. That's
Mm.
hard to calculate. It depends on the company, on the size, and a lot of factors. So when they say that all market lost how many trillions
Mm.
because it
Mm.
just went
Mm.
down 10, 20%, they didn't lose anything. It's just math.
Mhm.
A couple of hedge funds sold a little bit, nowhere close to 10 trillion. It's just on the paper, you became poorer. It's like if your
Yep.
house, for example, in your neighborhood lost 10% of value, it's not like 100,000.
Hmm.
You didn't lose
Hmm.
anything, really. It's just
Hmm.
on paper, it costs
Yep.
less.
Yep.
It's just a little bit it's a mind game which finance people like to play and maybe fear
Mm.
monger and trick you into fear, trick you into the excitement because it's very nice to show these numbers, Oh, this had an effect. 5 trillion came back market, and no one
Mm.
invested 5 trillion. Of course,
Mm.
it would have been a way different effect of that. Also,
Mm.
another fun fact, but it's even more math and anything than other than anything else. I like when they say, Dow Jones or S500 did uh, again 5 trillion a day growth or 2 trillion. It's
Hmm.
the record.
Hmm.
Well, of course, it's
Hmm.
a record because it's every week or every month it's growing, right? So the number itself, the denominator, is growing. So
Yep.
it can be the same 9% move. Yes, 9% move is nothing to sneeze at, it's not too common.
Hmm.
But in real terms, in real dollar value, it's the biggest ever because it's as expensive as ever. You know what I mean? So
Hmm.
the same 9% move somewhere 20 years ago wouldn't have looked at like 5 trillion. It would have been in billions. So, okay, whatever. Congratulations. You got a high score just because you're in this period of time. Now, the percentages are more relevant, of course. 9% move is a
Sure,
9%
sure, sure.
move, 20% move. But
Sure.
when they, throw
Hmm.
trillions at you, well, okay,
Yeah,
whatever.
yeah.
So this is a little bit about price and market cap, just for you
Nice.
to understand this. Was it helpful?
Yes, very much. This is good. Yeah,
Okay, now we
yeah.
got getting even into more important things, but even less understood. I
Okay.
don't know if we've spoken about it or we haven't, but do you know what's the safest investment there is in the world, or at least considered to be? If we have spoken, then it's a review of the knowledge. If we haven't, then it's a question.
You
What is
like
this? Yeah.
the long term kind of thing? Is
Yeah,
that the
there.
answer?
Yeah, no. So there is a specific financial instrument which is considered to be the safest one in the world.
Oh, no, I don't know that.
This is U.S. bonds. U.S. bonds, they have different duration. So what is a government bond, right? The government bond is the way for the government to raise money, right? They can't sell
Mm-hmm.
shares of government, but they can sell debt. So
Mm-hmm.
say we need to fund something. We need $1 trillion. How can they do it? They issue $10 trillion worth of bonds. The bonds, they have time to maturity. So they are always issued at well, almost always, but let's call it always at a for a certain period of time. Can be 3 months, half a year, 2 years, 10 years, 30 years, right? 10, and 30 years are main bonds in the US. So when they issue a bond, it has a time and it has a
Mm-hmm.
yield, meaning how much you're gonna get paid for borrowing to
Mm-hmm.
the US government, right? For the simplicity of this exercise, let's say it's $1,000 bond, right? So if today the US government were to start to raise money and they would say, we will sell certain amount of bonds at for $1,000 each, right? Let's do this. Okay, and it will be paying you, for example, 4% per year.
Mm-hmm.
And the maturity is 10 years, meaning you get a piece of paper which in 10 years you will be able to change to $1,000 you invested. And throughout all these 10 years, it says that you will be paid 4%, right? So every year you will be paid 4%. Now, is it a good investment? Is it a bad investment? It depends, right? What comparing it to. But it is considered, first of all, to be the safest in the world. Why? Let's start with this. Before we get into
Mm-hmm.
yields, let me explain why it's considered to be the safest.
Mm-hmm.
Because the United States has never declared the bankruptcy. It is considered that the US is a world reserve currency still. So all the bonds which United States have ever issued, they
Mm-hmm.
always met their obligation, meaning that when the time comes, the
Mm-hmm.
US has the dollars to pay. This
Mm-hmm.
is essential for any investment in the world to have something to refer to. They know that the US government always pays its debt. Now, obviously, if they one time they decide not to pay or something, happens, then it's going to be a different conversation. But there is an assumption in the financial world that that's never going to happen, and
Mm-hmm.
US is the only one who always pays its debts. That's why it is considered to be the safest investment.
Mm-hmm.
Remember, we spoke
Sure.
about it in the first video. When you pick an investment, you always have to consider risk and reward.
Mm-hmm.
If you're expecting any sort of reward, there should be some sort of risk, right? If I tell you I'll give you a double, then the chance is probably 50-50, right? If there is a double and your chance is better 50-50, then you should be taking this deal. If it's worse, then it's
Mm-hmm.
probably not a good idea, right? Now, US bonds act risk-free returns. It's considered to have no risk. Now, how is it possible that there is no risk and they still pay you 4%? That's a good question. And it's more than a good question, all right? It's a very it's almost a philosophical question how it happens because from what I just explained to you, it shouldn't be possible. It means there is some risk there, but it's considered all the risks possible. Now, there is also such thing as called traditional portfolio. The people are kind of pivoting away from it, but
Mm,
back in the days, all the money managers, the simplest one would be bonds and equities.
mm,
Equities are the shares, the stocks. Bonds to
mm,
equities, 40-60. 40% of bonds you invest your money, 60% in equities. That because equity is supposed to grow faster in value. They you buy them so they appreciate in value. The
mm,
bonds you buy them so you get paid the stable yield, and like your money is not going anywhere. You're gonna get your back in a for like certain amount of time. More than that,
mm,
stocks are usually growing when the economy is growing. When people
mm,
are hungry to invest, they buy the companies. Why the tech stocks did great in the last couple of a decade or so, or 2 decades already, because people were betting on the technology. They were willing to take more risk. Who did the best? Who took all the risk possible investing in Apple, Amazon, Netflix, against all odds, when these guys were sitting in
mhm,
the garage selling books or,
mhm, mhm,
trying to stream on dial-up internet kind of thing. The people who took a lot of risk in this, they are getting the most of the rewards because obviously they grew, right? So traditionally, when there is a turmoil in the market, when, for example, there is an unforeseen event, just like we had in 2020, you remember, when there was a pandemic, here the stock market dropped a lot. Right? It was also, scary headlines, but for a different reason. So the stocks dropped. The portfolio, if you only held in, let's say, most of your money in S&P 500, in a couple of weeks you lost 35% of the time. Now, what did bonds do? In the same time, by the way, this is not the price of the bond, that's the yield, and I'm
mhm.
getting there. The yield here dropped. What does that mean? Can yield drop if the yield is fixed, right? We said that when the government issues bonds, they fix the yield. So how can
Yes.
yield, why is the yield changing here? Can you guess?
No, not at all.
Because you can trade bonds. Because it's a $1,000 bond, but I'm telling you, Hero, it's paying you 4%. So I'm gonna pay you 1,100 for this, but you're gonna only get, 1,000 later in 9 years. Sure, but I'm gonna get paid 4%. But if I buy it from you for 1,100, it's not gonna be 4% anymore. It's gonna be less because I paid more for it. Same thing if you're like, you know what, I want my money now. I don't want to wait 10%. I don't want to wait 10 years. Take my money. I'm selling $1,000 bond for 900. Your yield is higher, or not yours, but the person buying it, obviously, because he paid 900. He's getting paid
Mhm.
4% on 1,000. So
Yep.
technically, he's getting paid. So what happened here during the pandemic in
Mm,
2020? The yield dropped. What does that mean? That people were rushing into bonds. Everyone were buying US bonds here. The prices started growing and the yield started dropping. This is not easy to your head around if you don't think, because it's illogical. When you see the price dropping, you think, oh, it's bad, or well, bad or good, that's a separate conversation, but the bonds
I understand.
has been
Yep.
bought at a huge
Mm,
amount of price because people were exiting stocks, buying bonds. Also, the interest rates were dropping. Do you remember that they were cutting interest rates? Jerome Powell was coming out and they cut rates. This interest rate, which US government sets up, is also very important. It's a base
mm,
rate. It's the smallest rate there is for anyone to borrow at. And usually rates always get the government and the biggest banks. It's not a conspiracy, it's just how it works. Because the biggest bank borrows from the US government. Now they need to make a margin. They, land at a little
Hmm.
bit of a higher rate. So by the time it gets to your mortgage, is
Sure.
not zero anymore. It's still 2%, right? Even though the government, oh,
Yes.
interest rate is zero. Well, my mortgage is not at zero. It's still 2%, 2.5%, whatever. Now the
Yep.
interest rate is like 3.5%.
Mhm.
Your mortgage is 7, right? So, but this interest rate is very important to issue bonds. So when the interest rate, official interest rate, which Federal Reserve decides, they can issue bonds at this yield and sell them. Now, for example, look at what's going on right now. US 10-year yield is going up. The stock market is dropping, well, rising today, but dropping for the past couple of weeks. And it was dropping too, but then it started skyrocketing. What does
Mhm.
it tell you? How is it possible? I know it's a lot of information. This thing, like just so you understand, this concept of bonds and bond yields, I think it's the most important topic on the economy, and it's the least understood by people who are not paying attention because it's not natural. No one kind of like paying attention to this stuff because it's not sexy, it's not interesting, it's not Tesla, it's not Apple, you know?
Well,
Who,
yeah, because the since the yield on the issuer level is fixed,
Mhm.
the the fluctuating yield is purely from the way that you just described it, which is interesting because it puts a spin in that fixed pressure, right? So there's a certain within which this freedom is uniquely created, I think.
Okay. Yes.
Meaning
So,
because
mhm.
that percentile is fixed, right? So then that's why you asked if it's fixed, how does it fluctuate? Well, what that obviously means is yes.
No, the present, I just want to make sure you understand me
Mm,
correctly. The
mm,
percentile is fixed at the moment
yes,
they issue new bonds.
correct.
So what they issued at, let's say, February 2020, right? They could have issued them at 1%, 0.7%, 0.5%. People
But
would
that
buy them.
stays fixed for 10 years.
Yes, but if you buy this bond right now, like,
Mhm.
are you gonna buy these bonds right now? No. Why would you buy a bond right now which pays you 0.5% if exactly the same bond issued a couple of months ago was issued at 4%? You're not going to buy these. You're going to drop them. You're going to try to get rid of them, sell them as cheap as possible, and buy exactly the same, exactly the same title. Or at least not sell them. But if you were to choose now, why would you choose exactly the same bond which pay 0.7% if you can buy one which pays 4? Same issuer, same duration. Well, those are like 4 years in, but
But that's right. So when that 10-year cap, so to speak, and then this fixed percentage, meaning not cap, but what I mean is something that doesn't move is the fact that this is years, but it's traded
hmm?
and your percentile is fixed, but it's also traded. So the idea that percentile is issued and at that issuing point the percentile is decided is of course based on not just what it is, but in the surrounding situation, right? The market influences that, obviously.
Of course. And
And
the go ahead.
why is it for us the least risk in terms of our investment? Isn't it simply because the result is guaranteed, or presumably without fail in the past been guaranteed?
Yes. That is the reason
So,
it is the least risky. Yes.
so of course, when something is as clearly as almost 100% guaranteed, then it's really not, I would maybe almost think in nature like an investment. Almost it almost looks like you're putting it into a bank, right?
hmm
Yet
Yes.
enjoy a bit of the juice that comes from this side of the game.
Yes. But now, what does it mean that the percentage is growing? And for like in general, what does that
Hmm.
signify? That the percent on the US bond is going up. Who is it
Hmm.
good for? Who is it bad for? what does it tell you in general about the situation, maybe in the world or in the US? Can you do some thinking and maybe logically just think about it?
Mm.
Because
Well,
Mhm.
if I am willing to what I could only promise 1% 10 years ago, but now I'm willing to promise 5%, is that the question? Why I would now put 5% instead of 1%?
Well, now okay, so now if the US government were to issue bonds,
Hmm.
they are forced to issue them at this percent. Because if they issue them less, no one's going to buy them, right? So the
Yep,
market is dictating them the percent.
sure.
And imagine a US government now have to, if they want to raise some money, they
Hmm.
have to take an
Hmm.
obligation for the foreseeable 10 years, let's say, to stick to 4.3%. It is a huge number because they're not
Hmm.
raising, $1,000. They're raising trillions,
Right.
and US
Yep.
already in debt. And US, ideally, what would be the ideal situation for the US, right? What are all these shenanigans they're trying to accomplish right now? Why are they crushing the stock market? Because they want to see this. They need this yield to drop, because if they drop the yield, they can refinance. They can issue cheap debt. Because if stock market, the logic is following: if the stock market is dropping, bond market is usually growing up. Because if you have a 10 billion, 100 billion to park somewhere, you're not parking them under your mattress. You have a few options. You have
Yep.
stock market, you have bond market. If the stock market is crashing, where are you going to put your money? The idea is you're going to buy the safest investment in the world. Now, if you were buying the safest investment in the world here in coronavirus thing, it did work like they said, but it didn't work here. It was supposed to go down. That would have signified that people, investors, countries, hedge funds are buying US bonds. Remember, buying, yield going down, but they're not. Something is not working. Why is not working? That's a good question. What do you think? Why people are not buying US bonds? Not people, but governments. Governments, remember, this stuff, like people usually don't buy this. I mean, you can, but it's mostly for the governments. So why is the governments not buying? Because they don't trust of what's gonna happen. They don't know if in 10 years US will be able to meet their obligations. Yes, it never happened before. They always met them. But will they in 10 years? They look at all the papers, all the stuff, and it's like, maybe, but they'll have to pay me 4%, not 0.5, 4%. So that's why probably yesterday the tariffs were put on pause, because they did crash
Mhm.
the stock market, but they didn't create any assurance in the US future. They didn't create assurance of US being here, being able to you know, pay their debt. So here, look, this is yesterday. Here the tariffs were paused, 4.5. So it dropped a little bit. Now they want to see what's going to happen next. If if Jerome Powell, Federal Reserve guy, Scott Bessent, Treasury, and President Trump do something, cook up something, make sure that no worries, guys, we're here, US is here, all fine, we know where we're going, then the yield will drop. And that is what they have to do, because Trump promised that they gonna lower the deficit, lower the US debt. And how can they do it? They cannot issue bonds at 4%. They can afford them at less than 3.5 maybe. So it really need to drop a lot. Once we see this, then Mr. Secretary Treasury, Scott Bessent, will be a very happy guy. He will probably know what's going on. Now here he was really getting nervous because the yield was going too much up. And by the way, who the a lot of bonds? I just learned it about this morning. Japan.
Yes.
Japan holds a lot of US bonds. Japan and
Oh,
China has a lot of US bonds.
yeah.
So US cannot afford to mess with them too much because if
Hmm.
they start dumping bonds, yield's going to go
Yeah.
through the roof. And yeah, I don't
Mm.
know. Did I blow your mind? Was it difficult? I know it was difficult. Was it somewhat understandable, somewhat interesting? Let me know.
I just have to ask questions in the areas that I did not understand because, like you
Sure.
say, Japan has known always to hold a lot of US bonds. And again, how that means in terms of this market fluctuation, all of that, that part I did not understand at all. So I have to, kind of ask more because I just don't understand
Hmm.
that mechanism so it's very intriguing, but I didn't understand the cause and effects, what actually and leads that flip of ups and the downs. I didn't really see how I can repeat it myself. No. How something would turn from upward to downward, whether it's a yield or price of this, I mean the percentile of it. I couldn't really connect the cause and effect.
Okay.
Yeah.
So this is a yield or the
Hmm.
percentile which
Hmm.
bonds are paying right now, right? There are bonds
Mm.
which have been issued 9 years ago at a certain
Right.
rate. They had two, three, I don't know. Can scroll back down and see whatever the percentile was at the time. Now, because they are tradable, they are trading at a different price. Yes, the face value, this is called the face value, is $1,000, but they
Hmm.
are sold at less, right? Yes, they sold it less, so they're paying more. So uh, this yield is going up or down depending of if there is a demand for bonds or there isn't. If countries, hedge funds, people, let's say money, are buying these bonds, this is gonna go down
Why?
because if you buy them, if you want to buy something which is cost 1,000, but I'm not willing it to say to sell for 1,000, I am only selling it for 1,100,
Yep.
right? So the
Yep.
price went up,
Yep.
but the yield went down because now it's 4%. 4% is still 4%, but not it's 4% from 1,000, right? This is didn't change, but you paid 1,100. So it's this number is not going to be 4%, it's going to be less, right?
Yes. Yeah. That's because
$40, right?
that.
And
Yes. So
that's because
that's
people
because
buying.
yes. And if I agreed to pay 1,100,
Mhm.
yes, in math, in my mind, it's gonna get me less 3% at the end of the day. So that part I understand. Okay. So
Mhm.
if I paid 900 for it, yes, in my math, I'm gonna get more than 4%.
Sure.
Sure. How does that have anything to do with then tomorrow a new bond is issued and how that percentile is supposed to be fixed? Does it have anything to do with the fact that I paid one thing at 1,100? So knowing, okay, uh, that was 1,000 with a 4%, but I'm now buying it at 1,100. So yeah, it's in my math less than 4%. It's going to turn out to be that. Fine. That at any point, I understand that that's
Hmm.
how I deal with that part. I don't
Hmm.
understand then when the US bond wants to be issuing another one tomorrow at $1,000. How would they determine at that point what percentile it should be? You said because of the market kind of thing, but that is where it gets all completely
Okay.
foreign territory for me.
Okay. Yes.
Hmm.
So now imagine
Mm.
tomorrow they want to issue $1,000 bonds, but they say we only can agree to pay 4%. Who is going
I
to
have to
buy?
accept that.
Huh?
I have to accept that now and cannot ask why would they decide on 4%?
No, no, like no, they can they are the issuer. They are like you and me. You're like, okay, I'll borrow you $1,000, but you'll have to 4%. I'll be like, okay, or not. It's up to me if I want to take this deal or not. The problem
But
is
I
that
heard
there,
that that is up to the lender, obviously, but it, that answer is influenced by the market, right?
well, if there is,
Meaning,
if
meaning
the,
the
Mhm.
demand,
Yeah,
because it,
demand,
like you said, you know what, I want this to be sold now, but I'm only offer 1%, and everybody looks the other way, and you still need the money. You're gonna have to say, okay, I'll give you 5%, right? So
exactly. Mm-hmm.
in that way, you're saying the market
100%.
got it. Okay, sure, that's
100%. So
understandable.
you
Yep,
only they have to respect this price because if you offer less, no
sure.
one's gonna buy them. So you didn't
Yep,
raise the money, so you're
yep.
bankrupt. So,
Now,
but
but
Mhm.
then I am understanding also, if I say I will give you 50%,
Mhm.
no one's gonna jump for it because one, not trustworthy that I offer 50%. But if it was almost guaranteed and I was able to offer that 50%, then surely demands will swarm my way, right? Or not. But let's just say that's the idea. Now,
Absolutely.
okay, then it's important that I guess America is constantly in need of money. If the company or the country in this case does not need any more external injection of funds, so to speak, uh, there's no need to issue any bonds at any percent because that would be not wise.
Yes. But the problem
So
is that
apparently, so it's
Mhm.
good that this country that issuing this bond of a good percentile and a promise is one growing, but two not too financially, I mean, cash flow wise successful.
Yes, but yet they still
Mm,
run. U.S. still is running on deficit, so they do need to raise money. That's the thing.
yeah,
So
that's the
remember,
thing,
we
is it?
showed this one in our first video is the U.S. national debt, and
Yes.
they are running at deficit, right? So they have to issue these bonds, and somewhere here,
Nice.
I guarantee you there is this 10-year yield because it's
Great.
now. So they really have to get to do something to lower the yield because
Mm,
they cannot afford to
yeah,
borrow at this rate because they would be digging the hole for themselves. Now, well, you
yes.
said that no, Japan, China, right? If they just start dumping it, just get rid of it, right? The percent is going to go up because the price is going to go down,
Sure.
right?
Sure.
A disaster. The US cannot afford it, but they have a one last um, tool in their tool belt, and this should probably
Mm,
wrap up at this because it's been
mm,
a long conversation, which didn't feel like it.
mm,
But there is a Federal Reserve and there is a
mm,
Treasury. Reserve is the central bank of US. Technically, they can start buying their own bonds. So the US can print the money and buy their own bonds, creating the demand,
mm.
lowering the yield. So why are they not doing it? Because
Well, I
they,
mean,
yeah,
yeah, you don't want to overly print, as we say, right? We
exactly.
we don't want to flood our own yard with our own currency because it just becomes garbage.
Yeah. There is another term, it's called QE and QT, quantitative easing and quantitative tightening. So it means that they are buying bonds or not buying bonds. During COVID, they were buying bonds. That's also one
Mm,
of the reasons why the yield dropped, obviously, because
mm,
US
mm,
was buying bonds.
mm,
But after that, Jerome Powell said that we want to fight inflation and we're not going to be buying bonds. We're not going to be
mm.
printing and flooding. And he's not doing it.
Yeah.
And
Mm,
President Trump is telling him it's time to lower the interest rate, print the money, and start buying the bonds. So now they
mm, mm,
really,
mm,
Jerome
mm,
Powell, the president of Federal
mm,
Reserve, Central Bank of the US, and Trump are really playing the chicken. Who's gonna keep
mm,
first? Is Trump
mm,
gonna say, whatever, and he stopped the tariffs. So, or will the Jerome Powell say, okay, it's good? By the way, today, just now, a couple of hours ago, the inflation numbers came in. Remember our first video we
Mm,
did when there was inflation number, and
mm,
the
mm, mm,
inflation
mm,
came
mm, mm, mm.
lower, which is good, which is
Good.
another, which it will make the decision for the interest rates easier for
Hmm.
Jerome Powell, so he can always say that it's not the Trump's pressure, but
Mm,
his
hmm.
data showed him that inflation is going down, so now he can cut the interest rates. So when he cuts the interest rates, the market's going to feel a relief because it's cheaper to
Yes,
borrow
yes,
again.
yes.
And if he announced the quantitative easing (QE),
Hmm.
meaning the Federal Reserve will start buying bonds, the yield will start dropping, and everyone's going to be like, "Whew, we have another couple of
Yeah,
years."
yeah, 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 yeah.
Yeah. So, by the way, Japan is also selling the bonds not just for fun and not just to stick it to the US, but because they need to support the yen. They need to finance it. But it's a Japan situation is unique and it's very interesting to me, not just because your background, but because Japan is a unique financial situation, really. But it's a whole
Mm.
different conversation. Yeah. So that's where
All
we
right.
are. Yeah, it wouldn't be a crypto podcast if I didn't mention Bitcoin. So the Bitcoin is obviously taking a hit together with the market,
Mm.
not taking a larger hit because usually Bitcoin is more volatile. But okay, it's like 25-27% right now from the top. And the S&P 500 is 15 and was or 20. So it's not bad, right? Usually it
Mm,
would be
mm, mm,
almost a
mm.
double. Bitcoin is
Right.
obviously a larger beast in itself. The market capitalization is 1.57 trillion, so it's larger than a lot of companies. It's still 10 times smaller than gold, for example, but it's growing.
Mm-hmm.
So I know that when you see a discount on whatever you wanted to buy, like if you wanted to buy a TV,
Mm-hmm.
you walk in Walmart and it's 27% a discount, you probably buy it, right? Meanwhile, the people who are new to investing, they are afraid of discounts and they're not buying. They're like, oh, maybe it's time to sell. Well, what? You know, it is a good time to buy. So it's always a good time to buy Bitcoin, in my opinion, but a 27% discount, definitely. So go get yourself an app and start buying, my friend. Next time, you'll not get off that easy without your homework. I'm expecting you to start putting your $5 into this chart and support it. Come on.
Let's do it.
Let's do it. Look,
Yes.
2073. It hit the previous high. It was a perfect time to, and maybe it's going lower. Who knows? But if it's going lower, you should be buying more. All right. Shall we wrap up on this topic
Yeah,
week?
let me digest all that. Yes.
Okay,
But more
cool.
to be had on this stuff, actually. Yeah. But for today, yes, let's wrap it up.
All right, Hiro. It's almost a
Yeah.
pleasure.
No, this is good. No,
Always.
it's good, good. This one maybe I want to touch on this a little bit more. I kind of got it, but it's more maybe I just need to watch it one more time. Maybe it's not for us to do another session, but I think it helps. It helps certainly it will help certain people that, kind of questions or whatever. I think so. It's good.
Yeah. Okay. Well,
All
thanks
right.
for watching. Leave your
No,
comments
thank
and the
you, thank you,
likes.
thank
Thank you
you.
very much. Bye bye.